This is InvestTalk. Independent thinking, shared success.
Hello, InvestTalk. This is Matt calling again. I have a question regarding Toro Company, ticker symbol TTC. I own it. It's about 2% of my portfolio. I'm down about 15%. Just wondering if it's still a good company to hold long term, or should I sell and move on? Thanks a lot for everything you do.
Thank you for the call. Looking at Toro Company, it's a name we actually own for clients. Not a huge position, but it's small. But we really like the business overall. Now, valuation historically has been, a bit above average, but you're going to pay a premium to some degree for a business that is just this consistent. Return on equity is 26%, return on invested capital is 16%. Over the long term, though, it tends to have a return on equity in the mid 30s. And now, the question is performance or is profitability structurally lower than it has been in the past? That's a big question, but it's still very, very profitable with a solid balance sheet, very minimal debt on its balance sheet. Free cash flow of about $466 million on a market cap of $8.2 billion. That's about a 5% free cash flow yield. That's pretty good. And what are they doing with that cash flow? Well, they're paying out a dividend. About 30% of that cash flow is going to a dividend. But the rest is just buying back shares. And that's a very good idea when you have this high of return on capital, return on equity, et cetera. So what now? No, let me back up. What does Toro do? They manufacture turf maintenance and landscaping equipment, irrigation systems. So think of commercial and residential lawnmowers and those type of products that are used to maintain your garden, your turf, football fields, etc. Okay, so great business, well run, and it's as cheap as it's been in a while, really since 2019. Enterprise value to EBIT is around 16 times. It was recently as high as 27, 28. Now it's at 16. I think it's undervalued here. The momentum is not there. Relative strength is about 25, not great. It's, been kind of in a downtrend since its peak in 2023, but not a strong downtrend, just a pullback to where it was in early 2022. So, we like it. Does need to firm up on its, chart. It's not a great chart right now. It's kind of neutral, near support. But if you're looking as a long-term hold, I would hold at these levels. Great business at a fair price. Now let's pivot over to a question that came in via the comment section on our YouTube channel. AD-CY7WX, I don't know who that is, but says, thanks for the review of my portfolio by Luke last week. Happy client. I guess he's a client. Talked to Luke last week. If you can, I have a large position of the REIT WPC. I'm in the red in share appreciation over the past 6 years. It's had a good run in this past week. It's solely a long-term income producing position. Thoughts on this diversifying holding REIT position over the next decade? Any warning signs? One day I'll just admit your portfolio beats mine, that I still manage, and turn it all over to you guys. Well, we're excited for that day, but in the meantime, happy to help. And this happens with clients. Some clients want to hold on to a small percentage of their portfolio and kind of do their own thing. And this is WP Carey. Now, historically, WP Carey has been a good performer. It is a global REIT. This is down pretty dramatically from its 2019 high, around 91. It fell during COVID, rallied back to about 87, 88 in that range. Fell recent lows in late last year, right around 50-ish. And now we're at 61. It's had a really nice rally, actually, over the past couple of weeks, going from about 55 here to about 61. So you've had a nice little rally, about 12, 13% over the past couple of weeks. Nice little bounce back. Now, what does WP Carey do? Let me pull this up. One of my other systems. This is a fairly large REIT, $13 billion market cap. Manages 1,555 commercial properties, both domestically and internationally. And that's the interesting thing with WP Carey. And as the commenter mentioned, it's well diversified. It's not just focused on one subset in the REIT space. It has office properties, industrial properties, warehouse, and retail facilities around the world. So it is very well diversified. I think one of the reasons you're down is duration risk. It's a bond proxy. REITs in general are bond proxies. And so if you get rates rising dramatically, that's going to hurt any type of bond proxy. It's also going to hurt companies that have debt on the balance sheet, which WP Carey does. It has $8 billion in long-term debt and a $13 billion market cap. That's not atypical for a REIT. But like I said, it's a well-run REIT. So I wouldn't be in a hurry to get out of it. The only issue to me is that it does have those office exposure around the world, and it varies depending on the region of how strong the work from home drive is, what downward pressure there is on rents, etc. So that's probably my biggest issue. But as a diversified REIT, I think it's definitely one of the better ones in the world. So I would continue to hold it as long as you understand that it's a bond proxy at the end of the day. And if rates do continue to go up, it will find some pressure to the downside. But near term, I think it's fine. Now, this is Invest Talk. Let's pivot back to your questions from 888-99-CHART.
Hi, guys. Big time listener here. My name is Neve. I'm from Boston. And I have a question about GILT, ticker symbol GILT. I already have this company in my portfolio, thinking to add more. Please let me know what you think. Thank you so much for what you're doing. Really appreciate everything. Thank you.
All right. Looking at GILT. This is an Israeli satellite company. And for many years, it was losing money, went profitable in 2021. And now it's supposed to earn 56 cents this year after earning 49 cents last year, and then 75 cents next year. This has been rallying nicely. Its relative strength now is 94. But at 75 cents per share in earnings next year, at a $7.69 stock, it's about a 10 forward PE. That's pretty reasonable. One thing I do like about this is it's foreign. A lot of foreign names are undervalued. They're starting to rally. And this has a great balance sheet, good valuation. Enterprise value to EBITDA is around 12, very cheap. And the chart is good. Let me pull up a chart on one of my other systems here. Yeah. I have no issue with it. Momentum's good. Valuation's good. The trends in earnings are good. I like it. This is GILT Satellite Systems, GILT.
Hey, Justin and Luke. This is Frank from Los Angeles, long-time listener of the show. Thanks for all you guys do. I have a question about senior living and skilled nursing facilities / REITs. I was reading an article online, and an analyst was arguing that the DOGE and the new Trump administration and agenda may have an impact on these REITs, especially those that derive a larger percentage of the revenues from tenants that are reimbursed through Medicaid and Medicare, which is, I think, a fair argument, although I don't fully understand the full extent of it. What do you guys think about it, and how would you look at this space in general? And second question, I was down looking at a specific name, which is Omega Healthcare Investors, OHI. Seems a good name in the space with a good dividend, fair valuation at the level, but I wonder what you guys think of it. Thanks a lot for all you guys do again, and I'll be listening on the show.
Well, let me speak on the nursing home industry as a whole. Now, first off, there's been a bit of overcapacity built out. Part of it's anticipating baby regeneration, as well as the Medicare reimbursements, as you said. And if DOGE comes in and tries to cut those reimbursements, obviously that will impact this industry dramatically. So there's certainly some risk there. That may be why OHI, Omega Healthcare Investors, like you asked, has been down so dramatically. Well, dramatically for a REIT, down from 44 back in October to about 46 and change today. Now, part of that are rates rising. We've said that before. Higher rates means pressure to the downside for REITs in general. Now, Omega is one of the better run healthcare REITs that are out there. Okay. And it primarily focuses on long-term care facilities. But there is that risk there. Now, could this be overblown? Could those cuts be minor or not material? Absolutely. But that does throw a little extra wrench in the risk factor here. Definitely more than normal. So, if you want to invest in the long-term care facility business, then Omega is, like I said, one of the better run ones out there. Return on equity around 10%. That's pretty high for a REIT, to be honest with you. So I like this one, but I don't love the space because that overhang of supply as well as potential changes to Medicare reimbursements. But I would keep it on my watch list for potential turnaround. I just don't see that happening in the short term. So I'd be patient on it. Thanks for the call. Now let's talk a little about stagflation. Now this is the buzzword in the 70s, right? And it really took down markets in a big way. And this was talked about in 2022 that we're going to have stagflation, and we did for a short period of time. And you saw equities correct dramatically in that time period. Right? Inflation, depending on your metric, went into high single digits, 8-9% or so, where the economy was growing, but at 2-3%. And that is a stark difference. Stagflation is really when the economy is growing below trend and inflation is persistently above trend. And that happened for, a handful of quarters around the 2022 timeframe. Now, right now, you're starting to see inflation reaccelerate. CPI is around 3%. And it's likely to continue to accelerate really through the year. More towards the back half of the year than the first half of the year. But so far, inflation's actually reporting higher than we were expecting for this time in the year. And then you have the tariffs that could pile on to this inflationary problem. And then you have potential deportation. Deportations are a shock to supply of labor. Tariffs are a shock to supply, which is the ability to economically import supply from abroad. And both of those are supply issues. So many people focus on demand, but supply is equally as important in the supply-demand curve to determine price. And that's what inflation is, looking at prices. Now, in the 70s, the supply shock was in oil, right? The oil, Iran oil embargo, etc. So these are different catalysts for stagflation, but they are certainly potential catalysts for stagflation. So I think the upside potential surprise of inflation is certainly there, and I think is growing by the day. Now, then you have to marry it with an economy that is growing below trend. Doesn't have to be negative, but if you're inflation at 4, 5, 6%, but the economy is growing 1 or 2%, that's not a great environment for risk assets, for just investors as a whole and the economy as a whole. And so that part is less likely for a couple of reasons. Because the consumer and the corporate balance sheets are relatively strong. Consumers have a ton of equity in their homes. They have mortgage rates locked in at 3% for the vast majority of them. Unemployment rate remains relatively low. Most consumers are in a very good position to maintain their lifestyle and their spending. Now, some of them are dipping into credit cards a little bit more, but it's from a very low level. Delinquencies on credit cards and mortgages are going up, but once again, from a very low level. So that's not really an issue. So consumers will likely continue to spend. Now, corporations, a lot of them have termed out their debt at very low levels back in 2020, 2021, and 2022. But now a lot of them are going to start to refinance later this year and into next year. And that's where I think the risk to the economy would be, that those higher debt costs suddenly cause corporations to lay off workers. And then that creates more of a snowball effect. But once again, that doesn't really happen until later this year and into next year. So while stagflation is an increasing risk, it's not a near-term risk in my mind. Because you're going to still have growth and inflation hovering around the same level, 2-3% or so. It's when they start to diverge, and there's a clear difference where inflation is materially higher than economic growth. That's where you get a 2022 scenario where the Fed has to get more hawkish, and that feeds into economic growth and to the downside. The cost of capital goes up, etc., and you get a 2022 scenario. So it's on the radar. It's a risk that's out there, but it's not a near-term risk. It's more of a medium-term risk in my mind. Now let's keep moving and get back to a fresh question from the comments section over on our YouTube channel. Lawrence Myers says, I have held BBY for just over a year, so it's now long-term gains. Is it time to sell, or is it a hold at these prices? Looking at Best Buy. Best Buy. I was actually in a Best Buy yesterday. For everyone out there, we're actually moving into new KP Financial's moving to new office, so I had to go there and get some equipment for the new office. But we actually own this for clients. We've owned it for over a year now, and it's been an uptrend. It bottomed back in late 2023, around $62 per share. Hit a recent high, a little over $100 per share, but now it's pulled back to around 90 and change at the close today. Earnings have come back down from a high of $10 per share in 2022, but still earning about $6.18 this year. So it's supposed to be $6.59 next year, and puts you at a mid-teens multiple. So lower than market average. But if you look at other factors like profitability, like their balance sheet, it is, I don't want to say glistening, but it looking very good. Return on equity, 42%. Very high. Now down from the 2021 high of 61%, but 42% is gangbusters, knocking it out of the park. Return on invested capital, 30%, also knocking it out of the park. And next to no debt on its balance sheet. Dividend yield 4%, with a payout ratio of only 63%, so some room for that to go up. Free cash flow about $1 billion, which puts it at about a 5% free cash flow yield. And what are they doing with that cash flow besides paying out a dividend? Well, they're taking that and they're buying back shares. So good stewards of capital, good business. It's kind of one of those things. It's like Philip Morris. I would say, long term, the cigarette companies have been great businesses. Why? Because who wants to get into a cigarette company? Or, especially after the late 70s when people realized that cigarettes are really bad for you. Nobody. They kind of left duopoly between, R.J. Reynolds and Philip Morris, and, nobody really wanted to get in the cigarette business. And so they just kind of printed money. And I see the same thing kind of here with Best Buy. Who wants to compete with Amazon and open a brick and mortar electronics company or electronic retailer? I don't see a lot of new ones like that coming out. So they're kind of the dominant player within the space, and that's why they have this high profitability. And then you have the Geek Squad on top of it. Where do you go to get your TVs hung and electronic help? They're kind of the one that's out there. And so that's why we own Best Buy. I would continue to hold it. Like I said, it's pulled back from about 100 to 90, but it's still in a very good position in a long-term uptrend. Good business, buying back shares, paying a dividend, etc. So still like Best Buy. Now, the InvestTalk voice bank never closes, and that's a good thing. So let's play another listener question from 888-99-CHART.
Hi there, Duncan from New York. Thank you for all that you do. I'm calling on stock ticker Kelly Partners Group Holdings, KPGHF. I know that this is an Australian stock. This was actually in part of my growth portfolio emails. What they are saying is that EBITDA was up 13% to 17 million, representing a margin of 28%. Return on equity for quarter one was 37%, and return on invested capital was 22%. I tried to triple check it. I looked on Fidelity Brokerage. I don't really see any information, just like a chart of it too, but I was looking to hope to see about your information. I think the sector is industrials and it is a micro cap, so I'm looking for this as a long-term part of my growth portfolio. Very small position in it. Thank you very much, and looking forward to telling me what you think. Bye.
Okay, this is Kelly Partners Group. $386 million market cap. Let me pull this up on another. Partners. Interesting. So it's an accounting firm. Like you said, it's out of Australia. These foreign names are always go to a different data provider that gets a little better information, less laid out, less well than some of my other data sources, but that's why it takes me a minute. But this operates an accounting business. It's just small and medium-sized businesses. And it does say sector industrials, but I think it's more financial, right? It's a CPA that helps with wealth management activities, accounting, taxation, audit, etc. It's certainly in a nice uptrend. Let me take a look here at some of the data. Yeah, I mean, the trends are very good. Like you said, it's an Australian name. Market cap about $584 million. Trying to get the data. I hate these. It's always new ways to lay this out. Okay. Yeah, I mean, the trends are good. I have no issue with this name, to be honest with you. I like the foreign exposure. I'm starting to really like foreign exposure. The dollar's starting to weaken. And everyone's talking about the dominance of U.S. stocks. And so far this year, foreign stocks are doing much better. And everyone's allocated to the Mag 7. Everyone's in love with them. And usually when, I think there was even a recent, I think it was Economist or Barron's about how the dominance of America, and usually that is a mark of a turning point. So I like the foreign exposure here. I like the growth. I love the business. These are type of businesses that are typically very healthy and strong, consistent. So I'm going to give Kelly Partners a thumbs up. Now let's fit in one more listener question today from our YouTube channel. And Joey Lombardi 12 says, question, I currently hold a small allocation of bond ETFs, BND and BNDX in my portfolio for diversification. At 38, does it make sense to continue holding them, or would it be better to cut my losses and explore other investment options in this space? Well, the simple answer is it depends. Depends on what type of risk you have in your portfolio and you're willing to take. You said it's a small allocation. Small is relative. Are you talking about 2%, 5%, 15%? What does small mean? Now, I'll tell you about these individually. These are just bond ETFs. One is the Vanguard Total International Bond ETF, that's BNDX, and then BND is the US Total Bond Market ETF. Now, with the US one, you're going to get a lot of treasuries in there. But you also have duration risk. Effective duration is 8.3 years. BNDX effective duration is 8.7 years, so a little bit longer. And that's my big issue, is the duration risk here. So I would sell them. Now the question is, do you put them into other bonds with shorter duration? Is what my first change I would make if you want to keep it in bonds. Once again, the issue here is the long duration. That's why you're down probably. So if you want to keep the same risk profile, just lower your duration risk with an ETF or individual bond with much lower duration than 8 years. Or you're 38, you have plenty of room, plenty of time before you probably need this money. I would take more risk with it. Now I have to look at your other portfolio, the rest of your portfolio. If you want to do a portfolio review with me, these are the things that we talk about. What does it make sense to do? What is your risk number of this entire portfolio? Is that 50? Is it 60? Is it 75? And then what is your risk tolerance level? How much volatility are you willing to take? Do those things align? So these questions are always difficult without more context. So I encourage you to schedule a portfolio review. Now, lastly, let's talk a bit about tariffs again. And Trump said on Wednesday that he will announce fresh tariffs not on imported cars or semiconductors or pharmaceutical companies, or sorry, pharmaceuticals, but lumber and forest products. And this is where the pressure to the downside on the home builders is really coming from. This is a big problem. And now it also could be opportunity, right? That this is just bluster. It's his way to get some sort of concessions. And this is just a minor blip for these home builders. And they bounce back. But I get the feeling that he's serious. And that's why I would be a bit weary of some of these home builders. And why you're seeing underneath the surface in markets more volatility. As I said, I think I said it on Tuesday. On the surface of the markets, things are calm. But underneath the surface, there's a lot of volatility because of this tariff situation. So don't be shocked, but know that a lot of times that volatility can mean opportunity. And in many instances, this whole bluster around tariffs will mean opportunity. But there will be ones that really take a much bigger dive than they already have around new policy. Now that could mean around RFK and HHS and the pharmaceutical names and the healthcare drug companies and health insurance companies. It could also mean in the industrial space, auto companies, semiconductors, like NVIDIA's. NVIDIA's kind of whistling past the graveyard. What if there are 20% or 5% tariffs on imports from Taiwan, for example? What does that do to TSMC? So understand that as this year goes on, as tariffs become more of a reality than just talk, there is more risk creeping into the markets. Well, that about does it. I'm Justin Klein. This completes another InvestTalk program. We appreciate you tuning in and liking and subscribing to our YouTube channel. If you head over there. And you can get to your podcast anytime at iTunes, Spotify, Google Play. Be sure to rate and review on iTunes as well. Remember, we can help you better understand your full financial picture, as well as your portfolio risk, and aligning that with your risk tolerance level, and aligning it with the current trends in markets by heading over to investtalk.com, scheduling a portfolio review with me or Luke. Independent thinking should success. This is InvestTalk. Good night.